Welcome to Deep Into Finance family. We appreciate you being here with us. Give us a like and subscribe to our channel. Share with your friends and family, and stay up to date to our future videos. The 2008 global financial crisis, also known as the Great Recession, was a period of severe economic contraction that began in 2007 and continued through 2009. The crisis had far-reaching consequences for the global economy, resulting in the loss of millions of jobs, the collapse of major financial institutions, and a prolonged period of sluggish economic growth. The crisis was triggered by a combination of factors, including the collapse of the U.S. housing market, the proliferation of complex financial instruments, and a lack of effective regulatory oversight. Causes of the crisis. One of the main causes of the 2008 financial crisis was the collapse of the U.S. housing market. In the early 2000s, housing prices in the United States began to soar, fueled in part by low interest rates and easy access to credit. As a result, many Americans took out mortgages they could not afford, often with little or no down payment. These subprime mortgages were packaged into complex financial instruments and sold to investors around the world. When housing prices began to fall in 2006, many homeowners found themselves unable to pay their mortgages, leading to a wave of foreclosures. The collapse of the housing market had a ripple effect throughout the global financial system. Many financial institutions had invested heavily in subprime mortgages, either directly or through complex derivatives. When the value of these assets plummeted, many institutions found themselves facing significant losses. Lehman Brothers, one of the largest investment banks in the world, filed for bankruptcy in September 2008, triggering a panic in financial markets. Another contributing factor to the crisis was the proliferation of complex financial instruments such as mortgage-backed securities and collateralized debt obligations (CDOs). These instruments were designed to spread risk across a wide range of investors, but they were often poorly understood and difficult to value. When the value of underlying assets, such as subprime mortgages, began to decline, the complexity of these instruments made it difficult for investors to assess the true risk of their investments. Finally, a lack of effective regulatory oversight also played a role in the 2008 financial crisis. Many financial institutions engaged in risky and speculative behavior, often using complex financial instruments to mask the true risk of their investments. Regulatory agencies such as the U.S. Securities and Exchange Commission (SEC) and the Federal Reserve failed to adequately monitor and regulate these activities, allowing the crisis to spiral out of control. Impact of the crisis. The impact of the 2008 financial crisis was widespread and long-lasting. In the United States, the unemployment rate rose to a peak of 10% in October 2009. And millions of Americans lost their homes as a result of the housing crisis. The crisis also had a significant impact on the global economy, with many countries experiencing a period of slow or negative economic growth. The International Monetary Fund (IMF) estimated that global output fell by 0.6% in 2009, with some countries experiencing much larger declines. The crisis also had a significant impact on the financial industry. Many large financial institutions were forced to take government bailouts or file for bankruptcy, and the crisis led to a wave of consolidation within the industry. The crisis also led to significant regulatory reforms, including the Dodd-Frank Wall Street Reform and Consumer Protection Act, which aimed to increase oversight of the financial industry and reduce the risk of future crises. In addition to the economic and financial impact of the crisis, the 2008 financial crisis also had significant social and political consequences. The crisis exposed widespread inequality and financial instability, leading to a growing sense of distrust and disillusionment with political and economic institutions. This in turn contributed to the rise of populist and anti-establishment movements around the world. Lessons learned. The 2008 financial crisis was a stark reminder of the dangers of unchecked financial speculation and inadequate regulatory oversight. The crisis highlighted the need for stronger safeguards to protect consumers and investors, as well as increased transparency and accountability in the financial industry. One of the key lessons of the crisis was the importance of effective regulation. In the aftermath of the crisis, many countries implemented new regulations aimed at reducing the risk of future crises. The Dodd-Frank Wall Street Reform and Consumer Protection Act, for example, introduced a range of new regulatory measures, including restrictions on risky trading activities, increased capital requirements for financial institutions, and the creation of a new regulatory agency to oversee consumer protection. Another lesson of the crisis was the importance of transparency and accountability. Many of the financial instruments that contributed to the crisis were opaque and difficult to value, making it difficult for investors to assess the true risk of their investments. Going forward, increased transparency and disclosure requirements could help to reduce the risk of similar crises in the future. Finally, the crisis highlighted the importance of a coordinated global response to economic challenges. The IMF and other international organizations played a key role in stabilizing the global economy during the crisis, providing emergency loans and other forms of support to countries in need. Moving forward, continued cooperation and coordination between countries will be essential to address global economic challenges such as climate change, income inequality, and geopolitical instability. The 2008 global financial crisis was one of the most significant economic downturns in modern history, with far-reaching consequences for the global economy, financial industry, and society at large. The crisis was triggered by a combination of factors, including the collapse of the U.S. housing market, the proliferation of complex financial instruments, and a lack of effective regulatory oversight. The crisis had a significant impact on the global economy, leading to job losses, bankruptcies, and a prolonged period of sluggish economic growth. However, the crisis also provided valuable lessons about the dangers of unchecked financial speculation and inadequate regulation. The crisis highlighted the importance of effective regulation, transparency, and accountability, as well as the need for a coordinated global response to economic challenges. While the scars of the 2008 financial crisis still linger, the lessons learned from the crisis can help to build a stronger, more stable, and more equitable global economy in the years to come. Looking ahead, there are concerns about the potential for another economic crisis in the future. While the global economy has largely recovered from the 2008 crisis, there are several factors that could contribute to another downturn in the years to come. One of the key concerns is the growing level of debt around the world. In many countries, both public and private debt levels are at historic highs, leaving little room for maneuver in the event of an economic downturn. This could make it more difficult for countries to respond to economic shocks, potentially exacerbating the impact of a future crisis. Another concern is the potential for a trade war or geopolitical conflict to disrupt global economic activity. The ongoing trade tensions between the U.S. and China, for example, have already had an impact on global trade and investment, and could lead to a broader economic slowdown if they escalate further. Finally, there are concerns about the impact of climate change on the global economy. The increasing frequency and severity of extreme weather events, as well as the longer-term impacts of climate change, could have significant economic and financial consequences. For example, rising sea levels and more frequent natural disasters could lead to significant infrastructure damage and loss of economic activity, while the transition to a low-carbon economy could lead to the write-down of fossil fuel assets and other investments. While it is impossible to predict the precise nature or timing of a future economic crisis, it is clear that there are several risks that could contribute to another downturn in the years to come. To prepare for these risks, it will be important for policymakers to continue to prioritize financial stability, effective regulation, and international cooperation. By learning the lessons of the past and remaining vigilant to potential risks, we can work to build a more resilient, stable, and equitable global economy in the years ahead.